Petty cash funds. What is a petty cash fund? A petty cash fund is an amount of cash kept on hand to pay for minor expenditures. This may include price for postage of small mailings or the purchase of miscellaneous office supplies. There are three key components used in a petty cash fund. Firstly, establishing the fund. Secondly, making payments from the fund. And lastly, replenishing the fund. Step number 1, establishing the fund. Firstly, the business must write a check for an amount of the fund. Secondly, the business must cash the check in at the bank. And lastly, the cash is placed under the care of an employee, also known as a trusted and custodian. Let's look at Ryan's robot store, for example. On January 1, Ryan cashes a check for $100 at the bank. He then gives the $100 cash to his trusted employee, Sam. And lastly, he then makes the following entry in his journal. Step number 2, making payments from the fund. Making payments from the fund can be done in one of two ways. Firstly, cash may be taken directly from the fund to be used to make the payment, or secondly, employees can make the payment personally and receive reimbursement from the fund. Whichever way is desired, the allocated custodian must collect receipts for the use of any cash. Step number 3, replenishing the fund. Firstly, the remaining cash in the fund is counted. Secondly, a petty cash fund replenishment report is created to calculate the total amount needed to bring the fund back to its original balance. So, again, using Ryan's robot store as an example, we can see that cash requested to replenish the fund and the total receipts both match $60. Once the petty cash fund replenishment report is made, Ryan then must create the following journal entry. Note here that expenses are debited and cash is credited, and again, both of these should match. What if the required replenishment amounts and receipts don't match? Well, sometimes there may be discrepancies whereby the custodian will not obtain receipts or will give incorrect change, resulting in a difference between cash needed and cash receipts. In this circumstance, a cash over and short account is a temporary account that can either have a debit or credit balance depending on circumstances. So, again using Ryan's robot store as an example, the discrepancy is highlighted below. Here we can see that the cash requested to replenish the fund is $65, whereas the total receipts only add up to $60, thus highlighting a $5 discrepancy. In this case, the cash over and short account is debited, highlighting an increase to expenses. Ryan will make the final entry as shown below. The cash over and short account would be debited $5. Therefore, both assets and equity are both deducted. Thank you very much.